Welcome back to the Ultimate Trading Podcast for beginner traders. I'm your host, Isabel Maria, and today we're diving into a critical aspect of trading psychology that often trips up even the most ambitious traders: overtrading. It's a topic that, if you're not careful, can be the silent killer of your trading success. I know it might sound counterintuitive, especially when we're all looking for ways to maximize our profits. The idea of getting in on every market movement can be pretty enticing. After all, we've all heard those stories about traders making big gains in short amounts of time. But here's the reality: overtrading can actually hurt your performance more than it helps. More importantly, it can take a huge emotional toll on you, one that leads to fatigue, stress, and, ultimately, poor decision-making. So what exactly is overtrading? At its core, overtrading happens when you trade too frequently, without giving enough thought to the quality of each trade. It's driven by a few common emotions: fear of missing out, or FOMO, the desire to make up for previous losses, or even just the excitement of being in the market all the time. This leads to high-frequency trading, where the focus shifts from quality to quantity. But here's the catch: this approach rarely pays off in the long run. Let's break down why overtrading can be so dangerous. First off, there are the transaction costs. Every time you execute a trade, there's a cost, whether it's commissions, spreads, or fees, and when you're trading frequently, these costs add up quickly. These extra expenses eat into your profits and can leave you with much less than you expected. Then there's the issue of emotional fatigue. Trading can be incredibly taxing, and when you're constantly monitoring the markets and making impulsive decisions, it's easy to burn out. I've been there, and trust me, you do not want to make decisions when you're emotionally drained. It's like trying to drive a car when you're running on empty. The likelihood of making mistakes increases dramatically. Another problem with overtrading is that it makes it hard to stay focused on your long-term strategy. Overtrading leads to a lack of focus, where you begin to trade on impulse rather than following a well-thought-out plan. The next thing you know, you're entering and exiting trades without fully analyzing them, and that can quickly result in a string of losses. And then, of course, there's the capital efficiency issue. The more frequently you trade, the more you tie up your capital in low-quality trades, leaving you with fewer resources to take advantage of high-quality opportunities that come along. This can seriously hinder your ability to grow your account in a sustainable way. Now, let's talk about the flip side of the coin: quality over quantity. By focusing on fewer, higher quality trades, you give yourself the space to truly analyze each potential setup. This means you're taking the time to study the market, identify high probability setups, and only execute trades when the odds are in your favor. When you take this approach, you're able to be much more selective in your trade choices. With fewer trades to monitor, you can dedicate more time to assessing risk, setting stop-loss orders, determining your risk-reward ratio, and ensuring that every trade has a clear purpose. This leads to better risk management, which is absolutely key for long-term success in the markets. In addition, trading less frequently helps you maintain emotional stability. The less time you spend glued to the screen, the more calm and composed you can be when it's time to make a decision. Trading with patience and discipline is one of the most important aspects of a successful trading mindset. And here's the kicker: focusing on quality allows you to be more consistent in your results. By sticking to a strategy that prioritizes high-quality setups, you're more likely to see positive outcomes over time, even if your trade frequency is lower. This is how professionals approach the market: they're in it for the long game, not trying to chase every quick win. Now, let me share a case study with you to really drive this point home. Let's talk about Sarah, a trader who was once very much like a lot of us, eager to jump into the market and take advantage of every opportunity. She had a solid amount of capital to work with and high expectations. But like many new traders, she thought that the more trades she made, the better her chances of profiting. So, Sarah began trading frequently, jumping into almost every market movement she saw. At first she was excited. But soon, the reality of overtrading set in. Sarah started facing increased transaction costs. Each trade she made incurred commissions and spreads, and over time, these costs began to erode her profits. Worse yet, the constant cycle of trading left her feeling emotionally drained. She found herself becoming stressed and anxious, and that took a toll on her decision-making. Instead of sticking to her well-laid plans, she started making impulsive trades, and, as you can guess, that led to poor decisions and a string of losses. Sarah's frequent trading also meant her capital was tied up in low-quality trades. She wasn't leaving herself enough resources to take advantage of higher probability opportunities when they came along. As a result, she was stuck in a cycle of low returns and frustration. But here's the turning point: Sarah decided to change her approach. She shifted her focus from quantity to quality trading. First, she created a detailed trading plan. This plan outlined specific criteria for entering and exiting trades, as well as risk management rules. With this plan in place, Sarah could resist the urge to trade on impulse. She also set clear entry and exit criteria, relying on technical and fundamental analysis to guide her decisions, rather than emotional reactions to market movements. Sarah learned the importance of patience. She stopped jumping into every market movement and instead waited for the right setups, the high-probability trades that aligned with her plan. To further help her discipline, Sarah set a limit on the number of trades she made each week, making sure that she only entered trades with the highest potential. She also kept a trading journal. This allowed her to track her performance, reflect on her decisions, and identify patterns in her behavior. Through this process, Sarah learned from her mistakes and became more disciplined in her approach. One of the most significant changes Sarah made was incorporating automated trading systems. By using an automated system that executed trades based on predefined criteria, Sarah was able to remove the emotional component from her decision-making. It helped her stay focused on quality trades, rather than the frequency of trades. So what happened after Sarah made these changes? Well, her trading results dramatically improved. By focusing on quality, Sarah was able to improve her trade selection. She managed her risk more effectively and maintained her emotional stability. Most importantly, she achieved greater consistency in her results. And as her consistency improved, so did her profitability. Now I want to ask you, how do you approach your trades? Are you focusing on quality, or are you getting caught up in the allure of trading as much as possible? I'd love to hear your thoughts and experiences. Drop a comment down below. I really enjoy hearing from all of you. Remember, overtrading is a trap that can undermine your success. By focusing on quality trades, developing a solid plan, and exercising patience and discipline, you can achieve far better results in the long run. Keep your emotions in check, stay focused on your strategy, and remember, it's not about how many trades you make, it's about making the right ones. Stay disciplined, trade smart, and I'll catch you next time.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!